Ladies and gentlemen, good day and welcome to the Hikal Limited Q1 FY22 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Samir Hiremat, Joint Managing Director and CEO. Thank you, and over to you, sir.
Thank you. Good afternoon and a very warm welcome. I am Samir Hiremat, CEO and Joint Managing Director of Hikal, and along with me I have Anish Swadi, President of Business Development and Strategy, Mr. Kuldeep Jain, our Chief Financial Officer, and Strategic Growth Advisors, our Investor Relation Advisors. We hope you and your family members are safe, healthy, and are continuing to take all the precautionary measures. I am pleased to interact with all of you on our Q1 FY22 earnings call, which is a change from our half-yearly calls. I hope you have gone through our earnings release, presentation, and financial results for the quarter. You can find these on the stock exchanges and on our website too. As an organization, we continue to follow all the necessary guidelines to safeguard our employees, as well as ensuring that manufacturing operations are not hampered due to COVID-19 reasons. Our company-wide vaccination drive has so far covered nearly 85% of our total employees, including a contract workforce, with the first dose of vaccine, while the drive for the second dose is also on track. We have instituted a special welfare program for our employees and their families who are affected by the COVID-19 pandemic. We began the previous quarter impacted from the effects of the second wave of COVID-19. While the impact was not as severe as the first wave and did not lead to complete shutdowns, it did have some impact in delayed delivery of raw materials and manpower availability. This, in combination with a temporary halt in supply of industrial oxygen in the month of May at our Taloja facility, also had an impact on the Q1 FY22 financial performance. However, we used this opportunity to perform annual maintenance activities in order to mitigate the loss of production. We reaffirm our full support to the decision to divert the oxygen from industrial use to medical use for the greater good, as the priority is public welfare. Now let me take you through the financial performance. Talking about our Q1 performance, revenue for the quarter was 457 crores, registering a year-on-year growth of 29%. Our Ebitda came at rupees 96 crores, which is a growth of 82% year-on-year. Ebitda Margins saw an improvement of 606 basis points to 21% as compared to 14.4% in Q1 of last year. The improvement in Ebitda Margins is due to higher volumes, favorable product mix, our business excellence initiatives, and higher operating leverage. HiBEX, the business excellence initiative of the company, which has been put in place, has enhanced the company's overall performance by increasing throughput and reducing costs of our existing products. It has helped us to improve our efficiencies and meet increased market demands. The company's cost of financing has reduced due to lower rates of interest, which augurs well for the company, and we expect the benefits to continue accruing. The company has moved to the new favorable corporate tax regime. The effective tax rate will be approximately 26% as compared to 35% in the last financial year. Our pharmaceutical division registered a strong revenue growth as well as an operating profit growth for the quarter, aided by the superior product mix and higher operating leverage. The division recorded a revenue of 274 crores, which is higher by 28% on a YOY basis compared to Q1 of last year. The EBIT for the division came in at 48 crores, which is a YOY growth of 121%. This translates to an EBIT margin of almost 18% compared to 10% in quarter of last year, expansion of 730 basis points. This past quarter, we received local approvals to start producing APIs at our Panoli site, and we will also be undergoing US FDA approvals and certification at this site shortly. An additional new multi-purpose production block was also commissioned at our will also be commissioned at our Unit 1 Jigni site in Bangalore in the next quarter. We have started supplies of Favipiravir API during the past quarter. Our crop protection revenue for Q1 was 183 crores, which is a YOY growth of 31%. The EBIT for the division was 32 crores, which is an increase of 89% compared to quarter one of last year. The EBIT margins were 17.4% for this quarter compared to 12.1% in the quarter one of last year. We had commercialized a new fungicide for a Japanese customer in our CDMO business last year, as highlighted in the last call. This quarter, we have successfully ramped up the production and increased volumes to our customer. Our business development team has been ramped up to capture new opportunities on the contract manufacturing and development side. Several new opportunities have been received from new and existing customers, and our pipeline has a healthy mix of opportunities. Towards the end of July, the Raigad region experienced unprecedented and very heavy rainfall. Due to this, our Mahad site located in this region bore the brunt of severe flooding. We immediately took a safe shutdown at the site to ensure safety of our employees. We have mobilized all the necessary resources required from our various sites to assist in the cleanup, restoration, and safe restart of operations at the site. We have completed most of the cleanup, and the repair to the damaged equipment is ongoing. All efforts are being made to ensure safe restart of operations at the earliest. Post several hurdles faced due to the pandemic, our CAPEX program is back on stream. We have commissioned additional capacity at development and launch plant in Bangalore. This is primarily for our new development pipeline in our CDMO business. We expect to complete several ongoing projects in the next few quarters of this year. We are working across our supply chain to minimize disruption caused through the pandemic. We have initiated efforts to backward integrate the key starting materials of the primary active ingredients and are collaborating with local manufacturers to reduce our dependency on China. We have taken proactive steps to develop both local and other non-China region-based suppliers. We are also partnering with European suppliers in certain specific areas for supply chain security. We have seen some success in the past quarter with our de-risking strategy, and will continue in the next few quarters to further develop and intensify and diversify our supply base. Currently, we are experiencing cost escalation in raw material prices due to shortages. In addition, freight rates have substantially increased over the past few months due to the pandemic situation and repercussions from the Suez Canal incident in the last quarter. Hikal has successfully established a strong foothold in the pharmaceutical and crop protection business. In line with our vision, we have set a bold aspiration of driving sustainable and profitable growth and moving to Hikal 2.0. As part of our transformational journey, and as we conveyed in the previous call, we have already engaged a leading global consulting firm to work along with us, which will enable us to pivot our growth in a sustainable manner. The journey forward will entail accelerating growth in our existing pharma and crop protection business, as well as investing in our emerging business verticals such as animal health and biocides. We have started our transformation journey to move to of Hikal 2.0 in the quarter. In terms of the outlook, we stand by our projected growth in top line at a CAGR of high teens, along with improvement of approximately 100 basis point improvement EBITDA margins per annum over the next 2 to 3 years. This growth hinges on multiple drivers, starting with our ability to convert numerous new product inquiries and new projects from our top global customers into concrete business backed by a global shift in strategy of creating an alternative to China by focusing on our core strengths. There is a shift in global supply chains towards a China Plus One strategy. We believe that India is likely to be a big beneficiary of this shift. The policy support from the Indian government through schemes like Performance Linked Incentive Scheme under Atmanirbhar Bharat is likely to provide opportunities for us in the near term. We have significant tailwinds in our business and are working towards capitalizing on several of them. With this, we will now open the floor to Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, please limit your questions to 2 per participant. Should you have a follow-up question, would request you to rejoin the queue. The first question is from the line of Rohit Nagraj from Emkay Global Financial Services. Please go ahead.
Yeah, thanks for the opportunity, sir. So the first question is, sequentially, we have seen a dip in both our crop protection as well as pharma business. So have there been any postponement of orders because of the logistical issues or the export orders? And will that effect come in subsequent quarters? Thank you.
Yeah, hi, thanks. To answer your question, there has been no deferment of orders. Our first half is always a smaller half as compared to the second half of the year, historically. And there is no impact of any delay of any orders. It will all pick up in the second half of the year.
Thank you. So the second question is in terms of new molecule development. So how are we currently placed and what is the timeline for the next 2-3 years in terms of commercialization of molecules across both crop protection and pharma segment? Thank you.
Sorry to interrupt, Mr. Nagraj, but there's a disturbance coming from your line. Request you to mute your line while the management answers your question.
Well, we have several products under development, and if you look at our crop protection business, we have 7 to 8 products under development at any given time, and our pharma business has a little bit more, about 10 to 12 products under development. Apart from this, we also have our own generic pipeline of own products, which we are developing. In the crop side, we are launching 3 new molecules this year, and on the pharma side, we'll be launching around 4 new products this year, which will be a mix of own products and CDMO.
Right, understood. That was very helpful. Just one last clarification on the 10-year multi-product deal. Any further update on the same? Thank you so much.
Yeah, thanks. So, the contract was signed as was made aware in our last call as well. And we've already started the work on the project. And the project is moving as per the timelines. Everything is on track.
Thank you so much and best of luck, sir.
Thank you.
Thank you. The next question is from the line of Dhaval Shah from Girik Capital. Please go ahead.
Yeah, hello. So first question is, any input cost, input raw material inflation is not visible in our margins. So has that been completely passed on, or is the operating leverage which is covering it up?
Well, there are 2 reasons for that. One is that there's a pass-through cost on most of our raw materials with our customers,
okay,
which was also asked in the last investor call. So there is a very little impact to us on the margins. Secondly, wherever there is an impact on our costing, we have improved operational leverage and operational efficiency. And our raw material prices have definitely increased in the pandemic, and there's a big issue right now also with shortages due to logistics and freight charges. But we're able to mitigate that to a large extent.
Okay, which raw material? Any specific where there is a large increase, if you can quantify?
No, I think that basic chemicals and some solvents have gone up because crude oil prices have gone up.
Yeah.
But mostly the transportation prices have really gone up. Freight costs have really increased. You must have seen a lot of newspaper articles on this as well. There's a huge increase, especially in the last 2-3 months. freight rates have gone up exponentially. But we have a pass-through clause with our customers, so we don't take much of the hit.
So pass-through is with each new PO which is made, so it's at a new price, or how is it, the pass-through? Because
it's annual price, and then we have a reconciliation clause, and then we have if there's a runaway price increase, then we can take it up with the customer, we can adjust it in every PO. Yeah.
Okay. So second question is on the Favipiravir contribution, if you can share.
Yeah, we did do some Favi sales in the first quarter. It's about 2% of our pharmaceutical division revenue right now. It's a small product, a niche product, but we are just doing whatever best we can to help with the cause for COVID.
Okay. And so the capex incurred, and what is the amount which will be capitalized in the current year?
Yeah, I'll hand that over to my CFO. Kuldeep, if you can take that call, please.
Hi. As we discussed in the last meeting as well, capitalization will be close to 300 crore for the entire year, which 75 crore has already been done in the quarter one.
Okay, 70. Sorry, how much you said, sir? 70?
75 crore we have already done, capitalization in the quarter one.
Okay. And next year, you are yet to give any guidance on the capex, right?
No, so we started our capex about 2 years ago. We had put in place a capex plan of about 300 crores, which is getting completed by end of this year. But we've also, in the meantime, we've acquired significant new contracts, one of which is a 10-year contract. And apart from that, we're also acquiring some new big contracts which we're working with our customers, for which we need even more capacity. So we're looking at this, but we expect to put in a fresh phase of capex for the next 2 years, which we will start, putting the capex steel in the ground maybe in the next few quarters, which should be another 250 crores over the next 2 years. But this will start once the 300 crore capex is over. We will start that next cycle.
Okay, so 250 crore over 23 and 24.
Yeah.
Okay, with the same.
Yeah, that's correct. FY23, FY24, yeah.
Got it. With the same sort of capital matrix in terms of the turnover, asset turnover margins.
Yeah, we have that very strict norms in our company, and we don't do anything if we're not hitting those norms. Yeah, we try and do even better, but at least that's the bare minimum that we try to achieve.
Got it, sir. Great, sir. Great. Good luck. Thank you.
Thank you. Nice luck.
Thank you. The next question is from the line of Viraj Mehta from Equirus PMS. Please go ahead.
Yeah, great numbers, Mr. Hiramat. So just a couple of questions. First was, if I look at our gross margins, they are at a 16-quarter high. Just wanted to understand, in your view, are these roughly 50% gross margin sustainable number?
Sorry, can you repeat that? I couldn't hear the last part of what you said.
So these kind of gross margins, in your view, are these sustainable in a slightly longer term?
We've given guidance for what we expect the margins to be. I mean, quarter to quarter, they could be a little up and down depending on the product mix. But, we had a favorable product mix for sure in quarter one. But whatever guidance we gave, 100 basis points improvement in margins year on year, I think we stick to that, yeah.
Right. And can you talk a little bit, just my last question would be, can you talk a little bit about the scale up in pregabalin and how has that worked out, and what's the scale we kind of see in that product, and how have been the spreads in pregabalin and thiabendazole?
How have been the what? Sorry, I couldn't hear you in the last. You're not very clear.
So scale up in pregabalin and thiabendazole.
Well, thiabendazole is volumes are growing every year. I mean, there's a marginal growth in thiabendazole volumes every year because it's a very old mature product. So, but the volumes are growing in low single digits for thiabendazole. But pregabalin we commercialized a few years ago. We've already seen a significant ramp up in the last financial year. For this financial year, we're expecting even a steeper rise in volume. And we're getting approvals in new markets, like the Japanese market just opened up a few months ago. We are the primary supplier in Japan to almost all the companies there. Europe volumes are increasing. We're getting some new approvals in the United States. So we are seeing a lot of interest in pregabalin, and we've got a very strong cost position, and we have a very strong, good technology on that. So we see this becoming a very large molecule for us in the next 1 to 2 years.
Sure. Thank you so much and best of luck.
Thank you.
Thank you. The next question is from the line of Sandeep from East Lane Capital. Please go ahead.
Hi, Samir. I have 2 questions. One is, if you could just talk a little bit about Hikal 2.0, how different would it be from current Hikal in terms of technologies, manufacturing infrastructure, the kind of products you can do? Just a broad sort of 3 to 4 year outlook. How different will the organization look in the medium to long term?
Yeah. Hikal 2.0 is something that we've been working on for the last year or so, and then we've formalized it through our global consulting that we brought on board in the last quarter. But the whole emphasis on Hikal 2.4 is having global leadership and becoming a global company in the fine chemical space, catering to the pharmaceutical industry, crop protection industry, and creating 2, if not 2, at least 1 new vertical of animal health, and taking it to the next level. And that's really about how we're accelerating our growth in margins, and also achieving revenue growth which is far in excess of what we've been doing historically. It's based on 5 key strategic pillars. One is manufacturing excellence, to set up large flexible manufacturing assets with high levels of digitization in Industry 4.0. The second is to work on complex chemistries and new technologies. The third is to de-risk our supply chain and to digitize our supply chain. The fourth is to become from a strong in EHS, which we think Hikal is already a strong player on EHS, to become a leader in value creation through ESG and sustainability. And the fifth is to improve our customer reach and become more customer-centric through our approach to key account management. Along with this, we're looking at digitization across the value chain in our company, and we're also looking at opportunities for partnerships, alliances, and even potential M&A going forward. So it's based on 7 pillars in which we're looking at our growth strategy of Hikal 2.0 over the next 5 years.
Understood. And can you talk about, you have mentioned this year how many products you would be launching, but just the funnel for crop protection and pharmaceutical, both on the CDMO side, how do you see that developing? How many are in phase 3, phase 2, or these are more products which will be getting genericized and you will be working with the innovators? Just a flavor of that would be very useful.
Yeah, so if you look at our crop protection side, we are currently having about 5 to 6 products under development or under launch at any given time, and that's the kind of pipeline that we're looking at. And we're actually seeing that number increase year on year. This year we'll be launching 3 of those products, all of those ones under development. On the pharma side, we have about 7 to 8 products on the CDMO side, and 3 to 4 APIs under development. And we again expect to launch almost 50% of that in this year and the next year as well. So the pipeline is pretty healthy. We've also strengthened our R&D center in Pune. We've got new labs, and we've increased the manpower in our scientific strength. And we're seeing increased traction on number of RFPs and inquiries increasing. So this number will start moving upwards as part of a Hikal 2.0 initiative. The idea is to increase this number dramatically upwards over the next few years.
And if I may ask one last question, just the opportunity you see in sitagliptin, that's a large volume product. You have clean chemistry, enzymatic processes there. What kind of an opportunity it could be? Is it a very large, exciting opportunity?
Well, it goes off patent after a few more years, so it is going to be a competitive molecule. But we expect to be like what we've done in pregabalin, get kind of a leadership position in the product because we've got a good traction. We've already got customer approvals. Again, we've got approvals in Europe, and Japan also has approved us as a supplier. We're talking to many other customers. So it could be a pretty significant molecule. It's still 3 to 4 years from expiry, but we're doing a lot of work And the process is very unique, and we have an enzymatic green process. So we believe that we're quite hopeful that it will become a very big molecule for us. But time will tell, but we're working towards it, yeah.
Thank you.
Thank you. The next question is from the line of Mithun Mehta from Lucky Investments. Please go ahead.
Yeah, hi. Good evening to the entire team, and congratulations on a great set of numbers and great execution. Sir, wanted to know from you, as within your crop protection and pharma, as to top 5 products and top 10 products contribution. Is it possible for you to quantify that number so that we can get some understanding?
1 minute, I'm just looking at one thing. I have the numbers for the top 10 customers. I can give you that. In our pharma division, top 10 customers contribute to around 70% of our revenue, but they have multiple products each. In our crop protection division, our top 10 customers contribute again to 75% of our revenue, slightly higher than the pharma, but it is with multiple products. No single customer in our either pharma or the crop business contributes to more than 10% of our business, and no single product, apart from gabapentin, contributes to more than 7 or 8% of our total business.
Okay, great. Sir, if you recall, in our previous Q4 conference call, you did allude to the fact that incrementally, our gross margins for new products will be in excess of 60% or closer to 60%. So is it the reason why our gross margins are looking far more healthier today and what they were used to before? If you could just throw light on that.
Well, new products, as I've been saying in the last several conference calls, new products contribution and gross margin is higher than the old legacy molecules. And as new products come in, of some of which have come in Q4 and more have come in Q1 because of the favorable product mix, there is definitely an improvement in gross margin, which is likely to sustain going forward as we launch more and more new molecules. So yeah, you're right. I don't know the number is 60%, but it's definitely in excess of 50%. Yeah.
So this year and next year, if you can just give us a roadmap of new product introduction in crop protection and pharma, in your CDMO as well as own products.
Yeah, I think somebody should ask me this question before you, but let me just repeat that. We're doing 3 products in the crop protection side and 3 to 4 products on the pharma side that we're launching this year.
And subsequently in FY23?
So about the same. So I think
every year
we'll go up slightly. We'll go up even more slightly probably. The idea is to intensify this as part of Hikal 2.0.
Okay. And how many such products would be there in your pipeline currently in your pharma and crop protection? I mean, at what sort of, how many products you would be working at this juncture?
So I'll answer this again. So we currently have in the crop protection side about 5 to 6 molecules that we're currently working on, 6 products actually to be exact. And on the pharma side, we have about 11 to 12 products that we're currently working on in the pipeline.
Right. And all of these products would be patented or they would be generic also?
They're a combination. The CDMO is more patented, the APIs are more generic.
Yeah. Sameer, I have a very broad question to you. Since, we track this sector for many years now, we've seen very successful wealth creation that has happened in this particular sector, be it DVs, be it PI industry, be it many other companies, Hikal obviously was the one which was kind of lacking behind for obvious reasons, which seems to have done phenomenally well in last 12 months and therefore will continue our good work. Just a question to you, where do you see yourself, with Hikal 2.4, 3 years from now, 4 years from now? Do you believe firmly that we can build a very scalable business in both pharma and crop protection?
Yeah, that's exactly what Hikal 2.0 is all about. It's excellence and leadership in both our pharma and crop protection business. I mean, we are one of the few companies that have both the verticals. Some of our competitors are trying to do what we've done. We've been doing it well. We've got a track record, and we're really seeing traction and growth accelerating now in both the segments, because we had a very good track record on compliance, ESG, and we've been a steady, our growth is going to intensify and going to get faster, and our margins are going to get even better going forward, yeah.
Permit me.
Sorry to interrupt, Mr. Mehta, but I would request you to join the queue, sir.
Sure.
The next question is from the line of Pranay Delia from Panchatantra Advisors. Please go ahead.
Sir, first of all, many congratulations on the stellar numbers and being a billion-dollar company. If you recollect last call, I said as a shareholder, let's look for 1 billion, and we did it much sooner than expected.
Thank you.
And I hope that this is just the starting point, as you said, and as a shareholder, I will be happiest if you become a $5 billion company, which I'm sure the management will help us.
Yeah, thank you.
So, two quick questions. One is, sir, what is the total debt figure on the books? And are you looking to raise any further debt, for the capex that you are planning, or the internal cash flows will be good enough?
Well, our current debt on our books has actually come down. It was 616 crores end of March. Now it is 595 crores. It has come down because our working capital has reduced considerably in the last quarter because of operating leverage and improvement in efficiencies. And what is the second question?
Not the second one. The continuation of this was that do you look to raise more debt, or it can be done through internal cash flow only, the capex that you're planning?
It's a combination of both internal and debt, because our cost of debt has also come down significantly. Interest cost has come down. As you can see, our finance costs and our numbers also have come down. So everything is manageable. As business is growing, our total debt numbers are coming down, and the percentage of
last call you said that you look to get debt free by FY23 end. So are we on track for that?
I couldn't hear you. Can you hear that? Did you hear that?
You said last call you said FY23 end you look to get debt free.
But as I know, we had informed the stock exchange as well, and we are currently undergoing repairs and cleaning up of the site. We are putting all the efforts to try and start the operations in the next 2 to 3 weeks.
So how much of production loss are we having, sir, in terms of revenue?
Well, our Mahad site contributes to about 15% of our total company, so on an annualized basis. So if we are out of action for 4 to 5 weeks, then we can do that number.
15% in 4 to 5 weeks. Okay, fine, sir. Thank you so much. That's it, and many congratulations again, and I hope we are working towards the $5 billion mark.
Thank you.
Thank you. The next question is from the line of Aditya Khemka from InCred Asset Management Company. Please go ahead.
Yeah, hi. Thanks for the opportunity. Sir, 2 clarifications. First of all, you said Mahad site, 15% of total revenue. Is that right?
On an annualized basis.
On an annualized basis, right. Okay, so that is clarified. And then earlier remarks you made on capex, so that was 125 crores for 23 and 24, therefore 250 crores 2 year put together. Is that right?
That's right. That's apart from the current capex which we are doing over the last 2 years, yeah.
Yeah. So just wanted to clarify those 2 things. Okay. So my first question is on the run rate, the revenue run rate that we have been doing in pharma and the EBIT margin. So we have been in that 270, 290 crores a quarter with about 16, 17% EBIT margin for the past 4 quarters. What is it that you see can now help us to go to the next leg? I know you are introducing 3-4 new products this year. You have said that on this call. But what is the market opportunity of these products? What is the stickiness of the revenue that you expect from these products? And what will drive the operating leverage? Because 17% EBIT margin in a CDMO sort of business in pharma seems suboptimal to me.
Well, as we get operating leverage and we get scale and we get volume increases, which is going to be happening in this year when our new capacity starts coming on stream in second half of this year, we expect the revenues to grow in the high teens as I've given guidance earlier. That will obviously improve our EBIT margins also, even faster than the growth in revenues going forward. Yeah.
Yeah. Understood. And sir, you made a comment on the gross margin where you said, you expect the gross margin to remain where it is this quarter at 51 or 50% in that region, given that your newer products have higher margin. But then, so your full year FY21 EBITDA was 19%. This quarter you have done 21. Yet you are guiding for 100 basis point expansion for the full year, for the coming few years, including this year. Does that imply that in the coming 3 quarters of this year, you expect some escalation in cost and therefore some suppression of EBITDA margin from this 21% towards 20%?
There's been a lot of uncertainties happening, and in this COVID year, there are freight issues, there are shortages in raw materials, there is flooding happening at site, there is oxygen shutoff. There's so much uncertainty in the business. We'd rather be, a little more conservative and give you some guidance rather than, obviously the idea is to do better than that. The efforts are to do better than what we guide. But in view of the uncertainty, this is what we believe, that we'd like to stick to the guidance we gave in post quarter 4 numbers, with the aim of trying to do better than that. Yeah.
Understand and appreciate that. So just one last clarification on the on the oxygen supply shortage that you had this quarter, the past quarter, first quarter of FY22. Could you quantify what impact that had on our revenue and margins, or just revenue if you can? Because I'm sure you were not able to produce a few products because you did not get the industrial oxygen.
Yeah. So the site was shut for about 3 weeks because of oxygen supply, and we used that time to do annual maintenance shutdown so that to reduce the impact on production, because that's why anyway have to be taken in end of Q1 or in quarter 2, which we normally do. So the revenue impact was about 5 crores for the quarter.
Around 5 crores for the quarter. Okay, so thank you and all the very best.
Thank you.
Your question is answered?
Yes, thank you.
Thank you. The next question is from the line of Ejaz Lakhani from Unifi Capital. Please go ahead.
Yes, sir. Congratulations on a fantastic set of numbers. I wanted some more color on gabapentin. My understanding is we have close to 1,000 metric ton capacity. So if you could clarify that and give an outlook in terms of how do you see prices moving, and also speak a little about the shift to pregabalin from gabapentin. Wanted some more color on that. Thanks.
Mr. Lakhani, so there's a disturbance coming from your line. Request you to mute your line while the management answers your question.
Is this better?
Yes, sir.
Yeah. So, congratulations on a fantastic set of numbers. I wanted to learn more about gabapentin. I'd like to learn more about our installed capacity. How do you see demand panning out? Do you see any, price realization pressures, any input price pressures, and how the shift is taking place from gabapentin to pregabalin? Thanks.
Yeah, right. Yeah. So, hi. First of all, the capacity is well in excess of 1,000 tons, significantly in excess of 1,000 tons.
Okay.
And the global market for gabapentin is growing even now, even during the COVID year. And pregabalin also is growing. And both we supply both the markets, so we are not seeing cannibalization of gabapentin because of pregabalin. They're both different therapies and the different segments of patients, that population that they cater to. There's a different price point, and it's both are growing. So while initially when pregabalin was launched genericized, there was a feeling that it may cannibalize gabapentin volume, but pregabalin has already been patented over the last several years, and we don't see that happening. So both continue to grow. Regarding the pricing pressures, I think the prices are stabilizing gabapentin and margins are stable. Raw material prices also are stabilized. So we don't see any significant impact on margins on gabapentin going forward. Hello? Hello?
Hello.
Yeah.
Yeah, I just want to understand that, could you give some quantitative color of what kind of growth you expect in gabapentin going forward? Hello?
Gabapentin is a very old product. We launched it in 2005. Right. So about mid to high single digits.
Got it. Thanks, Siddharth.
Yeah.
Thank you. The next question is from the line of Anish Munka from JST Investments. Please go ahead.
Thank you for the opportunity, sir. So my first question is on the emerging business vertical of biocides. Like we have already mentioned in our FY20 annual report that we have commercially launched one biocide, and how we also have a pipeline of products at various stages of development. So could you please share about the current developments in this vertical, the opportunities that you foresee, and the competitive advantages that we bring to the table? Thank you.
Yeah, thanks. I'll just hand it over to my strategy guy. Anish, can you take this?
Yeah, thanks for the question. So, yeah, biocides is certainly an interesting vertical for us. We see a significant growth potential over the next 3 to 5 years, primarily coming from imports coming in from China and demand in Europe as well as the US market. We have a portfolio of biocides that we've identified, which are currently under development. We have initiated some customers in terms of sending samples, and we've received some positive response. It is part of our overall strategy to diversify the crop protection vertical into creating another vertical under biocides and specialty chemicals. So we do see this potentially as growing over the next several years, just like we've talked about the animal health division. In terms of quantification, it's a little difficult to say today what we expect, but we definitely think that this could be a 100+ crore potential over the next 4 to 5 years as we go forward.
Yeah, thank you. My next question is, so what we hear from like every CDMO, API, chemical or pharmaceutical company is that they are all augmenting their R&D capabilities. So have we seen any increased attrition or salary inflation in our R&D division? Also, in addition to that, I wanted to understand the board's thought process behind ESOPs, given that we are already a billion-dollar company. Thank you.
Well, you're right. I mean, every company is looking at R&D, but we have not seen any significant attrition increase in the last year. I mean, we've got very good policies for our employees. Hikal has won the Great Place to Work and Best Employer brand for several years in the country. And we have lots of employee-friendly policies in the company, taking care of employees and their family members. So we have a very manageable attrition levels in our company. That's the question. So we don't see any issue. They're below industry average on the attrition level. The second question is regarding ESOPs. We do not have an ESOP plan in the company. We have an incentive program for our employees based on performance and long-term kind of a Hikal 2.0 and our next 5-year vision. We've got a long-term plan for our employees based on that.
Thank you and all the best, sir.
Thank you.
Thank you. The next question is from the line of Raghunath, an individual investor. Please go ahead.
Hi, sir. This flooding issue is occurring too often. Last time also we have suffered because of floods. Is there any long-term fix for this so that this is not repeated?
Is it long-term fix? What is the question? Is there a long-term fix because of flooding?
Flood.
Yes, sir. So that we can avoid these kind of situations in the future. Is there any plan for that?
Yeah, we're relooking at our new facilities and we're putting in place all the anti-flooding measures. But if it rains 840 millimeters in 24 hours, I mean, there's no system can avoid that. This is the worst rains in the last 50 years. So this is absolutely peak. Last year's flooding was minimal compared to this. This year was a very severe flooding situation. But whatever new plants that we're building and new sites we're doing is we will ensure that we take care of these measures to the maximum extent possible. And MIDC, we're working with the Mahad MIDC to help us with desilting of the river and improving the width of the river, which was the flooding which took place. So there's a lot of measures being taken to hopefully ensure if this does happen, then we can minimize the impact on operations. Yeah. And this is where our multi-site strategy really comes into play, where we can have production moved around from one side to the other. Even though we've had an impact in the Q2, because our production capacity of some of our products are on the higher side, we can make up the volumes. in the remaining 2 quarters of the year. It is an issue which has repeated itself in the last 3 years, but we'll do our best I can. There are some global warming issues which is beyond our control.
Okay, thank you, sir.
Thank you. The next question is from the line of Dhaval Shah from Girik Capital. Please go ahead.
Hello. Yeah, sir, when we lose a revenue because of this flooding or some other issue like the oxygen supply issue, so being a process industry, can we recoup this revenue or it's lost?
Well, as I just mentioned to the earlier person, that for the product that we have in our Mahad site, we have some spare capacity. So the plan is to make up the lost revenue in the course of the next 7 months or so. And there will be a loss impact probably for 1 quarter, but we will make it up in the following 2 quarters.
Okay, so the client would use it. So in some next batch, he will be using the product.
Yeah, no customer orders have been deferred or cancelled because of this.
Okay.
We reached out to all our customers and they've said no problem. It happens in Europe as well.
Yes.
As you know, there was severe flooding in Germany and in Belgium last month.
True.
It's happening in China as well. It's happening all over the world, and customers understand. And they reaffirmed their commitments for volume for this year. It just got deferred from 1 quarter to the other.
Okay. And so second is, so in the second quarter, should we around 20 crores of revenue should be deferred because of the flooding?
Well, we are assessing the impact. Currently, we're assessing more, and we're trying. All efforts are being to restart the operations as soon as possible, and the safety of the operations are very important. As you know, we want to start with a chemical plant. We want to start operations in a very safe manner without having any incident at any of our sites.
Okay.
So we'll have more clarity probably by next month, by end of this month when we hopefully restart operations. Yeah.
Okay. And sir, last question. Sorry. Sir, given the inflation, because in various in steel and a lot of other raw material, our project IRR must have got disturbed because of the capital equipment cost increasing. So the same is getting adjusted in our contracts, what we do with our customers?
Yeah, wherever we have new projects coming in, if there's an increase due to input cost increases, we are having discussions with our customers and adjusting our selling prices accordingly.
And they are happy to, are they asking us to share or are they taking it up? Like majority are we able to pass on?
Well, nobody is happy to take a price increase, but with a discussion, and we are quite successful on most occasions. And sometimes it is sharing, sometimes they take most of it. So we have to improve our efficiency. That's part of our business excellence and our high-best program. By improving our efficiencies, right? To improve capacity utilization, improve capacities and throughput. The combination of several of the things.
Thank you. Ladies and gentlemen, please limit your questions to 1 per participant. Should you have a follow-up question, would request you to rejoin the queue. The next question is from the line of Rohit Nagaraj from Emkay Global Financial Services. Please go ahead.
Thanks for the follow-up. So just one question in terms of CDMO projects. So generally, what is the threshold revenue size that we look at when we are looking at any project? And what have been the inquiries flow from? Are these coming from a particular geography or a particular set of chemistry segment? How has it changed over the last, say, 2-3 years? Thank you.
Well, CDMO project, because the NCEs and then clinical trials, phase 1, phase 2, phase 3, they start off small, but then they get ramped up as the product moves from one phase, part of the clinic to the other. We look at a product from obviously with the peak revenue potential, but we also look at the relationship value that we have with the customer. So we have a key account management concept in the company where we identify our key customers and we build a basket of products with them. Some may be large revenue products, some may be smaller revenue products with higher margins. It's a combination approach, yeah.
Right. Thanks a lot. And any geographical split up that we are seeing more inquiries from a particular geography?
Well, historically, we were getting maximum inquiries from US and Europe, but now we're also seeing a lot of new inquiries coming in from Japan. So that's been a change in the last 2-3 years, I would say, and it's got even more intensified in the COVID era.
That helps. Thanks a lot and best of luck, sir.
Thank you.
Thank you. The next question is from the line of Pranay Delia from Panchatantra Advisors. Please go ahead.
So just a follow-up, at what percentage capacity are we operating currently?
Around 85 to 90% currently.
That's optimal at the moment in that case?
Yeah, that assumes downtime for maintenance and all that. This is after taking everything into account. This is not, yeah, so we
can only improve on this once we have new capacities added from next quarter onwards.
Yeah, we can
do top line growth.
Yeah, that's true. But slight improvement maybe in operational efficiencies, but the new campus is coming on stream.
So that will have 1.5x asset turnover. That will add further to the revenue. So this is basically the top revenue we can do with the current asset size we have.
And the product mix, right? If you look at our quarter to quarter, there's a variation in revenue because of product mix. So if product mix changes, then you get a little bit more than what we are at today.
In that case, sir, can you also guide us a little bit on the current volume growth you had, not only on value growth, the volume growth in terms of sales you had?
Yeah, just 1 minute. I'll just give it to you. Let me get my papers. Yeah. So the volume growth for the company for this quarter was 28%.
That's just volume growth, not value growth.
Value was 29.5 and volume was 28.1.
Okay, that's fantastic, sir. Thank you so much. Thank you.
Yeah.
Thank you. The next question is from the line of Aditya Nahar from Alpna Enterprises. Please go ahead.
Yeah, hi sir. Thank you for taking my question. Just wanted to sort of check with you. 3 years back, what was the percentage of revenue coming in from newer products, and what is it in 2021? If you can give me those details.
3 years or 4 years back, if I go back, it was probably about 5%.
Right.
Today it is around 10%. We expect in the last year, and we expect that to be sustainable, if not and marginally increase year on year.
All right. So do you have any target in terms of next 4 or 5 years, X percentage would be from newer products?
Yeah, by the next 5 years, as part of our transformational journey, we want to get to 20% of our revenue every year with new products over the next 5 years.
Great. Thank you so much and best of luck.
Thank you.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to Mr. Samir Hiremat for closing comments.
Thank you. I would like to take this opportunity to thank everybody for joining the call. I hope we have been able to address all your queries. For any further information, kindly get in touch with the Strategic Growth Advisors, our Investor Relations Advisors. Thank you once again and stay safe. Goodbye and have a very good evening. Thank you.
Thank you. On behalf of Hikal Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.